Welcome everyone to the future of real estate by the Center of Real Estate Technology and Innovation. I'm your host, Ashkan Zandieh. My guest today is none other than Travis Connors. Travis is the built environment tech venture capital savant at Building Ventures. On today's show, we will do a deep dive and discuss what owners and investors are doing to future-proof their business in the age of technology and innovation, debunking myths about built innovation, the key drivers of real estate tech, the optimized real estate experience and what that means, trends driving the recent boom in real estate tech, and a whole lot more. Travis, I'm so excited to have you on the show. Welcome.
Thanks, Ash. Great to be here.
Absolutely. I gotta say, I'm a huge fan of your company and all the companies that you've invested in. But for those of you, that don't know you and are starting to kind of like learn about you, like what's your origin story? Like, what is Building Ventures and how did you get started in this business?
I like how you put it as an origin story. Venture capital. I don't know that that's very much a superhero career, but nonetheless, I like the idea. So I come from background
for sure.
Yeah, I come from the background of being an investor, really first. So I got my start as an apprentice on a derivatives trading desk in London, and quickly realized that I did not want to do that. Was fortunate to get hired at a more traditional asset management firm in New York, where I was taught the skill set and practice of really securities analysis and evaluating public companies. And I've always been really enamored with technology. And so being a young person there, learning, really excited about tech, they gave me the freedom to really explore that area and started to get to a deep dive, and gave me the opportunity to move actually out to the West Coast, where I happen to be today, normally based in Boston, so I could be closer to those companies, which they thought would work out really well for them. I thought would work out really well for me. In the end, it taught me to have a completely different passion about startups. And the reason for that was I was out here by myself. I needed to get some office space. I rented a little office in a building on University Ave in Palo Alto that was filled with startups. And not knowing anything about setting up an office, I ordered water service, not realizing that when you do that, they bring you 2 jugs of water, whether you drink it or not, every day, or every week rather, which meant my office was filling up with jugs of water. So, and like all good startups who are resource constrained, I started inviting people, hey, if you need water, I've got water. And so I got to know all the other startups in the building. And from that, was thinking, this is so much more interesting than what Intel and Applied Materials and Comag and all these other companies are doing. The startups are where it's at. I got to find a way to work with and be useful and helpful to startups. And not knowing how to write any code at all, and being an investor, that was, what are financing sources? And that's where I really learned about venture capital. And so moved back to the East Coast to join a venture capital firm, Egan Managed Capital, which was started by the Egan family, who'd founded EMC, large data storage company, best performing stock on the New York Stock Exchange in tech in the 90s. And this was 2000, and really helped work with them to put together a venture firm focused on early stage software in the New England area. And that's where I came across Jesse Devitt, my co-founder at Building Ventures. Jesse had spent his whole career in AEC software, architecture, engineering, and construction, was running a venture firm and really focusing his own investments in that space of design and engineering in particular. And in 2006, he and I co-invested in a company that would now be considered an early smart cities kind of company. We're trying to figure out how to use the cloud to coordinate activities between municipalities and utilities, and so citizens wouldn't have the roads dug up, and we could have better services and better maintenance, and frankly, use less asphalt and less disruption. And with that investment, that really opened my eyes up to just how backwards the worlds of real estate and construction were in utilizing technology to even understand their operations and the data that was available that they weren't taking advantage of. And yet we were looking at every other industry was capitalizing on technology. And that kicked off really a 10-year discussion with Jesse and I on the tech is available. When is the behavior going to shift and change so that we can actually start to leverage and take advantage of all this innovation? And around 2015, we looked at a lot of deals together and thinking about it. And at the time, it was still very, very niche in what is now considered, prop tech and the broader industries of construction real estate tech. And a few things were emerging. Post 2008, the financial side of real estate operations started to really look at how do we get tech so we can have a better understanding of our assets. And it was really focused on the balance sheet and the P&L, but nonetheless, it was them beginning to get more comfortable with software. There was a study put out by the UN that said that we'd tipped over and now half of humanity lived in cities, and that was going to increase to 70%. And there was really interesting result of that is you have to build the infrastructure to accommodate another 2.5 billion people, 2 billion of which are going to live in cities. What that means is you have to build 2.5 trillion square feet of buildings, which is equivalent to all the existing footprint of buildings that we have in the world today, but you have to do it in 30 years. And so we thought there's absolutely no way that that can be accomplished. The people are going to move. We have to build the buildings. There's no way that can be accomplished unless we think of new methodologies and frankly, get greater productivity out of what we've got. And then lastly, SoftBank, for better or worse, but for better for us, put a ton of money into Katerra, which was a manufacturing attempt at building buildings, and WeWork, which we all know. And as a result, the industry woke up to, there may be disruption to our delivery model that we have to be aware of. And so we went out and kind of surveyed the industry and said, hey, you guys have known this stuff exists for a long time. Are you ready to start thinking about technology adoption? And the test for us was, could we get those people to invest in a venture fund that would support the startups that they would be the customers of? And if they were ready to do that, then it might be a signal that there was a different attitude available to the use of technology. And so 2016, we incorporated, we raised our first fund. We gathered it from people from across that landscape, the life cycle that we pay a lot of attention to: architecture, engineering, construction, real estate operations, and the occupiers themselves who run their own space. And thought we need to optimize life cycle, and that's how it all came together.
That's incredible. That's absolutely incredible. And speaking of your first fund, are these funds, like when you set up your first fund, is it more like in real estate, when you set up a fund, we use the term very generically, but is it more of like a syndication, or is it like a true fund and there's like capital actually allocated to this fund? Or is it more like a syndication where it's like capital that's earmarked? And I asked that question because for anyone that's listening, that's looking to launch a fund or get into venture capital and wants to start investing, like how do you kind of go about setting that up?
It is a blind pool of capital. That money is committed for a 10-year period of time, and then we have the discretion to deploy it into those companies. And so we have a very fragmented group of LPs that represent all that space. So we're not investing on behalf of anyone or their interests specifically. Mm-hmm. They have to collectively be behind the idea that by innovating across the life cycle, we're going to deliver a better built world, and they have to rely on us to figure out what companies to deploy that in along the way. And one of the reasons why, strategic investors or industry investors are willing to do it is our first mission is to see all the innovation that's happening in the space. And if we're aware of that, we can pick out the investments we want. But it also means that we become aware of really interesting companies, or more importantly, individuals who are solving problems that may be, relevant to one of our LPs, our limited partners, our investors, which isn't an investable deal, but could be a great thing for their business.
Yeah, I applaud you for that. I think one of the things that's really amazing about you and you specifically is that how entrepreneur friendly and how entrepreneur forward you are. You've backed some incredible entrepreneurs like Envoy, Honest Buildings, Join Digital, Measurable, Mosaic. I mean, like the list can go on, and that's a real testament to you as a person. But I saw something on LinkedIn that I have to ask. Prior to founding Building Ventures, you were doing something else. You were working on a secret project to help design, build, and improve the world. I'd like to know, like, it was very cryptic the way it was written on your LinkedIn. Were you working on like a stealth company with a 200 million pre-seed with
No,
a
no,
purpose
no.
to like repurpose underutilized office in Boston for like crypto mining on Mars or something like that?
No, actually, that's you're reminding me that I should probably look at my LinkedIn profile more often and clean it up. The secret project was this, right? It was building ventures. Jesse and I, as I said, it'd been a long time coming that we were thinking about whether or not the market was ready for this. And I think if you just look at capital deployed into the prop tech space, 2000 to 2015, 2015 to now, you see an amazing inflection point that happened in 2015. You know, frankly, we were lucky. We had instincts that it was coming. We had no idea it would come as fast as it did. But we knew from those factors I talked about before that it has to happen, right? We've all heard the statistics that buildings consume 40% of the energy, they produce 40% of the greenhouse gases. What is less talked about is they also consume about 40% of all raw materials, and they produce about 40% of all landfill waste, right? I mean, when you talk about a situation that is just absolutely unsustainable, buildings are it. And lots of people were afraid to go into the real estate construction space because it's so highly fragmented and there's so many parties, and it's a really difficult coordination problem. But like all important things, that's where the hard problem is where you can have the biggest impact, and you can't just continue to ignore it. Like if we fix transportation, that's great, but it doesn't do enough. There was a report put out, there's a really great newsletter, Climate Tech VC, and it was matching up areas of the IPCC, the latest IPCC report on where we can have impact on greenhouse gas and where the venture dollars have gone. And you look at micromobility, and I like scooters and e-bikes like everybody else, but very small opportunity for offsetting greenhouse gas emissions from the trips on micromobility, and yet the most amount of venture dollars. HVAC, which is an area that I never would have thought I would have invested in, and have now invested in 4 companies and will do more in the HVAC space. Biggest opportunity, least amount of venture dollars. And so it was a secret project because, like anything, you don't want to tell the world you're going to do something if it's not going to work. We weren't sure that the market was ready for this kind of a firm and a fund.
That's incredible. That's really incredible. You make a really interesting distinction between, because conventionally we use a term like construction tech or built tech, or real estate tech or prop tech. You use a very distinct term, built environment tech. Like, why? Like, what's with the distinction? Like, I'd love to kind of get some insights into that.
Yeah, well, we really look at the whole built environment, right? This world we live in. We try to take a systems level approach to thinking about it. And the problem with it today, as I said, there's all these parties who have small slivers of responsibility that very often nobody's thinking about the actual outcomes that are going to be delivered, and not thinking about that outcomes over a 10-year period of time. I was hosting a panel discussion yesterday, and we were talking about payback periods, 3-year, 5-year ROIs on putting innovations into buildings that are 100-year assets, right? And it was, how do we get people to start thinking about what we need to have there for tenant 40 years down the road, 50 years down the road, the occupant at that time. So by doing that, we try to step back and say, we need to optimize how we design, build, operate, and experience space. We need to find ways to create positive feedback loops that we learn from that instead of restarting and building prototypes every time, which is what we do with buildings today. And so as a result, when you actually peel back where the money's gone, a huge amount of money goes in the transactional side of real estate, which makes a lot of sense. That's where the money is spent. It's a little bit like Willie Sutton and Why Do You Rob Banks? But it's not an area of focus for us, because while optimizing how we lease and rent and sell and market can build some interesting businesses, it doesn't solve this fundamental problem of how do we get more sustainable, more resilient, more delightful space delivered more quickly with more efficiency with a lot less waste. And so that's where our focus is completely, and that's going to be in that other life cycle.
That's incredible. I have to ask, you see, so obviously you see a lot, like, and we're seeing a lot of noise about inflation. I want to kind of talk about real estate for a second, kind of talk about what's actually currently happening in the economy in the US. Like, we're seeing a lot of noise about inflation and impending recessions. We're seeing companies like JP Morgan boost reserves on bad debt. I'm assuming there's probably even some real estate bad debt included in that. I can only imagine that lenders in real estate are doing the same. And we're also seeing governments invest heavily in construction and infrastructure. And we're also seeing the Fed trying to tame interest rates. With all that said, as a VC in this space, I'd love to kind of get your thoughts on what the heck is happening in this market.
Yeah, well, there's a lot to unpack there, and one of the benefits of being an early stage investor is we don't worry too much about the business cycle. We have to invest in whatever market cycles that we find ourselves in, because the companies that we're investing in now, we don't expect to exit for 8 to 10 years. And so if multiples are 100x revenue, that's fantastic. If they're 10x revenue, that has to be fantastic. And so we have to adjust our expectations and entry pricing going into that. But we think over the long term, a lot of this washes out. Now, we do think it's a very terrifying time for the capital stack for real estate. Cost of money is going up for sure. Predictability of the cash flows of the assets is going up. And one of our key theses is that buildings have historically been operated as financial assets. You lock everybody into a 7-10 year lease, you get the building leased up, and you sell it, right? We think that consumer experience, the ultimate amenity that the end user wants is flexibility, and that flexibility will translate into shorter lease terms, and that shorter lease terms is going to make cash flows much less predictable, which means you're going to have to pay a lot more attention delivering a much better consumer experience to the occupants of the building every day. And so money will be available for making the best buildings. Money is going to be really hard to come by for buildings that are not. So we think that owners are in a tenuous spot, which is actually plays well to what we see, which is those best buildings are going to be the ones that employees are happy to be in, that residents are going to happy to be living in, that deliver a really good indoor climate experience, that have the conveniences that you need to get whatever you need to get done in those spaces. There's an awful lot of money that wants to invest in sustainability and will provide, green bond financing and the rest of it for those kinds of projects and properties. But for everybody else, I think there's as much new build opportunity as there is, and that may cool down on that based on that business cycle. There's a huge retrofit need, because on the other side that you didn't mention with the financial pressure is the regulatory pressure, right? You're seeing it in New York and LA and Boston and Chicago and everywhere else, of regulators wanting buildings to be able to reduce their energy consumption.
It's really fascinating. I'd love to kind of stay on course on the real estate side for a second. Use a term, when we're prepping for our call. I love the term you came up with, is optimized real estate. We often hear terms like optimization thrown around in the industry in terms of like process innovation. Some have actually overused it, so it became a buzzword. I'd love to kind of get your thoughts on what is optimized real estate, and who does it impact, and why is it beneficial to the industry?
So a couple of things there. So, the reality is that the whole industry, design through operations, has really prospered in its inefficiency for a long time. And we just don't think that the stakeholders that exist today aren't going to allow that to continue. And there's an enormous amount of wastefulness. And yet there's a bunch of conflicting goals, right? So if you look at all the stakeholders, from the capital stack behind a building, the owners, the operators, the municipalities, the regulators, and the regulatory frameworks they exist in, and then the ultimate really important one is the end user, the consumer tenant, whose people are in there every day, all have either conflicting or competing interests. And a really good example of that happened in COVID, where, hey, we want to make sure we flush the building and have more outside air introduced all the time. Well, then you are increasing at the same time, we want you to reduce your energy costs. Well, if you're going to be running, refreshing the building 20 times a day or 25 times a day, and humidifying and dehumidifying and cooling and heating that air, that's massively energy inefficient, and it's bad for the equipment, which was not designed to operate that way. And so fundamentally, we think that the optimization comes from understanding what are the needs of all of those constituencies, being able to gather the data that allows you to really understand what's true versus what people intuit they want. And then being able to apply the analytics to balance all of those, right? So we have a portfolio company, 75F, which has a control overlay system for HVAC systems. Notoriously a Byzantine controller, very hard to create new set points and navigate if you're not an expert. 75F was designed so kids could do it. But the idea is you flood a building with very cheap sensors that can tell you everything from temperature, humidity to occupancy. When you have something like the ASHRAE and CDC say you should flush the building more often with fresh air, that's just being done randomly in other buildings and energy costs go up. With 75F, they were very able to quickly code a pandemic mode, which basically said, this is what we want the indoor air quality to be. This is how often we need to change it. Based on occupancy, you, the machine, decide when and where and how to do all of that, when energy cost is the lowest, when occupancy is the lowest, and make sure that whenever people are here, we're hitting all the guidelines. It is an example of optimization, but it has to be optimization so that you can actually control the systems in the environment, and at the same time trying to do all those trade-offs between the various stakeholders.
Wow, that's really fascinating. I'm assuming besides 75F, there's a handful of other portfolio companies that might support that optimization strategy. Actually, a company that comes to mind is Measurable. I've seen their name come up quite often over the past few, quite honestly, years. I can only imagine the company's current business development pipeline. Like, walk us through a company like Measurable, for example, and the whole entire from when you first met them, when you realized like this is a fantastic company, to where they are now.
Yeah, I'm glad you asked about them, because we love all of our portfolio companies. You're like your children, you love them all equally. But Measurable has a really great origin story itself, and has really come into its own in the last few years. So Measurable was started by Matt Ellis. Matt was a commercial real estate broker in Southern California who was just noticing this pattern of, he had lots of clients who wanted to be in lead buildings, and there weren't enough lead buildings. Simple supply and demand problem. He tried to understand why that was, saw that it's a challenging thing. It's somewhat political. There's a whole bunch to it. You weren't going to create a bunch of lead buildings quickly. And yet it was what are you really looking for? And it was clients, forward-thinking tech clients mostly. So we want our people to be in great spaces. They care about sustainability. We care about sustainability. And Matt said, what if we could understand the sustainability performance of all these real estate assets, and went out to build software to do that so that you could apply it to lead buildings, but also every other building. And that was 2011, right? So 10 years ago. He didn't raise venture money really for the first 6 years, because at the time it was Matt and Lance and his small team were pretty much the only people who believed that this was going to be important. But he knew in his heart that if the really good customers cared about the sustainability performance, eventually everyone would care about it, and all buildings would have to be able to report on it. And so they built a package of software to be able to do ESG performance management for real estate assets. When we invested in 2017 seed round, I think they had about 50 million square feet, which they had clawed their way to get by going and discovering those really thoughtful owners like Boston Properties or tenants like Salesforce. And today, I think they are now over 13 billion square feet, the largest footprint of commercial real estate, where they are doing ESG performance reporting and analytics on, which gives us an amazing data set for now what is the most important thing that we need to do in commercial real estate, which is figure out how we decarbonize. But it starts with gathering the data, having the data in a manageable way, and then being able to do analysis on it. But those are the kinds of founders that we really look for. Very, very deep conviction. There's a great venture capitalist, Mike Maples at Floodgate, who has this notion that he calls the team with the earned secret. And I really love that idea, right? Matt's earned secret was he saw that this was going to be more valuable to people, the right kind of customer. And because of his conviction in that, he was able to gather this amazing team who worked tirelessly for 5-6 years, clawing their way to their first 50 million square feet, to go from 50 million square feet to 12, 13 billion in the subsequent 5 years.
It's It's an incredible journey. It's really incredible. Kind of staying on that same theme. I recently read that building materials account for a structure's total lifetime carbon footprint. We're seeing a lot of conversation and chatter at the intersection of ESG and prop tech. I mean, you can't pick up the Real Deal, Commercial Observer, or quite honestly any digital publication these days without reading about prop tech and ESG. If the architecture and the building industry intends to significantly reduce its greenhouse gas emissions and meet their ESG objectives, do you see any opportunities for tech companies and early stage tech companies, like entrepreneurs that are entering the tech companies, and entering the prop tech ecosystem?
Tons. I mean, so like I said, we have a portfolio company, AeroSeal, and they have their opening slide of their deck, and I think it was probably the moment that I was sold on we should invest in it, was buildings are killing our planet. Right? We need them, but they're really terrible for all of us, and so we have to figure out a way. And today, I think that the opportunities are in that optimization, whether it is the figuring out how to instrument and gather the data, being able to then create analytics that enable us to understand what that optimal usage pattern is going to be, and then the ability to actually manipulate and manage the building. Our most recent investment is a company called Animated Insights, which is really a building operating system that looks like a digital twin just because it makes it easier to navigate the systems. And they, one of the things that I really like, they start with the hard problem. It's easy to take BIM from a new construction and have all that data. They didn't go there. They went to the Chrysler building and said, we're going to take the most old, heterogeneous, hard to control system and be able to move it so that the building engineer can control the whole thing on their iPhone. And being able to have that level of control, first it's going to be for the humans to operate these buildings, and then eventually we'll be able to build up ML models and AI models that will allow the machines to optimize the control of those buildings for us. I think that's the first place. We've spent a lot of time looking at building materials. Building materials are a huge part of the problem, and we have to figure that out. We have to figure out how to use materials that are better for the environment. Concrete and cement is 8% of our greenhouse gas emissions. It's the best building material we have. It's the cheapest building material we have. There are a lot of really interesting approaches to try and figure out how to decarbonize cement. Some of that will come through chemistry. Some of that will come from regulatory frameworks. There's a very risk-averse industry. We have an LP who is a risk management of a very large ENR top 20 contractor who said, we are a risk management firm that just happens to build things. And so if you go to them and say, we've got this cement, it's very different from any cement you've ever used in the past, but trust us, they don't, right? We have thousands of years of history with cement. It's a highly trusted material, but we're going to have to get better at exploring those things.
Yeah, I read something, and I've seen the whole porous concrete, porous cement, breathable cement, self-healing concrete. I mean, this is all incredible stuff.
Well, the real problem is cement, which is the glue inside of concrete, is basically limestone. And the way we turn it into cement is we use an enormous amount of energy to bake it, and the baking process is unlocking the CO2. So it's a double whammy. So we have to figure out how to decarbonize the cement manufacturing process. But we had a speaker yesterday who also talked about the fact that it is also a really good sequestration material, because what happens over time, all of the CO2 that is released in cement wants to be reabsorbed naturally. And so over time, the built environment could actually become our biggest store of carbon sequestration if we figure out how to deliver net zero early and then have it pull back in CO2 from the atmosphere. I'm not a big believer in that. There's a lot of challenges around carbon sequestration, but even if we're emitting 50 gigatons of greenhouse gases every year, if we can get that down to zero, we still have to deal with the problem of all of it that's currently in the atmosphere. And so we have to figure out some sequestration opportunities as well.
I feel as if we can just geek out on, and nerd out on carbon sequestration. We can take the entire hour talking about that. It's an entire fascinating process, I don't want to dive too far into it and go down that rabbit hole. I kind of want to stay on the construction
Sure,
side
sure.
real quick. You have another company that recently raised or publicly announced their $64 million round, and that's Built Robotics. Huge fan of that company, they raised a $64 million round. I believe it was led by Tiger Global. You guys were involved. You guys were early investors in the company. I think Fifth Wall also was involved in the investment Founders Fund and New Enterprise Associates. Walk us, for those that don't know the company, talk about all the amazing things that they're doing on the construction side of the autonomous vehicle trucking industry.
Yeah, so construction has a massive, skilled labor shortage problem, and we are continuing to accelerate the pace at which we are retiring workers. It remains an unbelievably tedious and dangerous job, and so we're not getting a new influx of construction workers. And so, again, in this need to build the world again in the next 30 years, we're going to have to figure out ways to automate a lot of those processes that we once had, frankly, excess labor, and now we have a shortage. And so we've spent a lot of time looking at the opportunities for where can we harness robotics and automation, and what processes can they do. And it's going to take a long time. What we really like about Built Robotics approach is it's aftermarket kit that can be put on top of existing heavy equipment, excavators, skid steers, etc., and can manage very precise tasks. The one that they are really focused on and their initial go-to-market is all around trenching and digging. And we got involved because one of our investors, Mortensen Construction, who is a very big player in the renewable energy market space, came and said, "Hey, will you take a look at this with us? We're really interested because we have a particular problem. We're building a lot of solar and wind farms in the Australian desert. That's digging an awful lot of foundations for turbines and for the panel plants. And it's a really hard job to hire for. I mean, the advertisement goes something like, hey, would you like to move to the Australian desert for 3 years and dig holes all day?" Not a lot of takers. Robot doesn't care. Robot is perfectly happy to dig the same hole over and over as long as you keep it, fueled up. And there's so much of that need as we do an energy transition that if all Built Robotics ever does is dig foundations, there's a massive market opportunity. But it's the kind of indication of here's where labor doesn't want to be. Here's a perfect opportunity for automation to go. So it's going to be some time before we see, a Built Robotics machine autonomously navigating between Turner job sites in New York City. But we don't need to get there. But it also, for us, again, it comes back to we want to invest with really amazing teams. And when we met that team and the way that they were approaching this challenge, right, there's been a lot of work in autonomous vehicle operation for passenger vehicles. We said there's going to be 2 dividends from this. This company clearly has a lead. The customers really believe in it. A lot of the things are very good about it. And then I suspect that you'll find the alumni of that company will end up starting lots of really amazing robotics companies in the construction space going forward.
Yeah, I think moving to Australia, I'd rather move to Byron Bay than to middle of the desert.
Well, it's 115 degrees at night, Ash. It's really quite comfortable.
Oh, fantastic. I can't wait. Speaking of portfolio companies and investments, I'd love to kind of, talk to the entrepreneurs talk to the entrepreneur side of it for a second. Are there any areas that you don't invest in when it comes to built environment tech?
Yeah, I would say back to what I was touching on earlier. It is that transactional end of the market. Again, I think that there's interesting opportunities to build a virtual leasing platform and tours, but it doesn't work to solve that fundamental problem. So if anything for brokers or lease management or selling, buying, any of that stuff is areas that we will pass on to our other friends in the market space. One of the things I really like about this whole world of prop tech investing is it feels very similar to me as it did when I started in 2000, just in generally software, where it's a smaller space. The funds tend to be smaller. We're, with the exception of Fifth Wall, all about the same size. And so there's a lot of collaboration, right? Everybody has different strengths. I think another really important part is a lot of people have LPs that come from the industry, right? One, we're always trying to help our companies iterate faster. And the way they do that is by spending time with friendly potential customers. And so, whether it's folks at Metaprop or Camber Creek or Navitas or brick and mortar, we often look at things together, knowing that everyone has the opportunity to bring other potential customers to bear. And if we see something that isn't for us, we know it's, the kind of thing that Zach and the crew do, we'll send it over to them.
I love the camaraderie of our community. It's something unlike anything I've ever seen. In the sectors that you do invest in, for the entrepreneurs that are listening, what stage do you invest in? And does a company have to have a certain like IR or TAM or cost of customer acquisition, cash flow, or something else?
Yeah, so we're big on making up words at Building Ventures, and so we like to consider ourselves what we call sapling stage investors. When I got started, when Jesse got started, there was very kind of traditionally defined sizes. You would do a seed round and it was, you'd raise $1 million or $2 million. Then you would do an A round and it might be $5 to $7 million. Then, if you got to a B, it'd be 10. And now we see seed rounds that are 10, $15 million. So things have gotten a little messy in that moniker. What we mean by sapling is companies that have the nucleus of a team of founders who really understand the problem that they're trying to solve. They have a good enough understanding of the value proposition they want to bring to market that we can test that against our network and our LP base to see if it finds resonance. And so we will invest in pre-revenue companies. We will invest in post-revenue companies. It's really about our ability to help. We try to meet teams as early as possible when they're getting started. We love what we have. We call our nurture portfolio, which at any time is probably 70 to 90 companies who, for various reasons, we either think the entrepreneur or the idea is really compelling and we want to get that out to market. We'll try and introduce them to people and watch that way, and then pick our chance to invest when it feels like we've now hit a place where we can really be useful in helping them get to market.
That's really incredible. Yeah.
And if it helps bound that a little bit more, out of our second fund, the checks that our initial checks range from $1.5 million on the very early side to kind of 2.5 as an initial check, and then we will deploy as much as $7 to $9 million in the company over time.
Yeah, that's really incredible. One thing that keeps coming up as amongst the entrepreneur community, especially people that aren't from tech, that are getting into tech, typically people that are from real estate. And then if you just read TechCrunch or any of the publications out there, you always see a handful of VCs invest together in a company. Do you ever come across a time where you said, we don't need anybody else to invest with us, we're going to write that 1.5 check for this, we want early access to this one company?
So we are big believers in syndication. One of the things that I've really loved that has happened faster, frankly, than I experienced is how much mainstream interest has come into our space. We can talk about why that might be in a minute, but to continue to support these companies afterwards. I think it is very useful to founders and entrepreneurs to have diversity of opinion when they're being advised. And so we will look to syndicate whenever we can. That said, there have been several opportunities where, because of either our knowledge of the founders or the market opportunity, our conviction is so high that we'll go in all by ourselves. We have a strong belief and thesis on the opportunity for generative design, and we have two founders that we have worked with closely and known for a decade, who are, if you were to scour the earth to pick the perfect two people to go and crack this market, it was them. So we didn't hesitate to write that check alone.
That's fantastic. I don't want to limit the next question to just construction tech, but I want to frame it around construction, given the revenue lift it has had. I recently read that construction companies have seen a lift in revenue amid the pandemic. We're also seeing a record number in total funding. Just last year, 32 billion. I believe it was Industrial Dive that recently reported that tech companies of all sizes have prospered since COVID. Why is that? Like, why is it such an exciting, like it's obviously an exciting time when you're when you're in the business and when you're an entrepreneur and when you're an investor, but why is it an exciting time, for everyone in prop tech?
So I think the pandemic forced forced some behavioral change that otherwise would have taken a long time to adopt. Construction is a very in-person activity for kind of the obvious reason. And yet when regulators say, well, you can't go on site, you have to find a different way. So, one of the bottlenecks in every construction project is the inspection process. You complete something, you can't move to the next step until the city or municipality signs off on it. Um, Oftentimes that is a trivial thing to just look at it, and is the valve there or not? Is that sealed properly or not? But the idea of a virtual inspection was anathema to anybody until it was forced. Well, we're not going to send somebody on site during COVID. Can someone on site just hold their phone and scan it? And now some of the inspector's office can, yeah, why would we ever go backwards from that again? Right.
Yeah.
And that's the kind of thing where you can speed up the whole process so effectively. And so, one of the markets that we've always been really interested in that has yet to really figure its business model has been reality capture on site. There's lots of speculation of, if we had a daily walkthrough and a journal and a look back so we could see behind walls, that'd be great for insurance claims and this, that. But it's been hard to get people to adopt. Well, when you can have less people on site and it becomes more important to catalog that information for people, all of a sudden that creates a pain point. On the real estate side, we've all seen it has made everyone more hyper aware of the space that they use and whether or not that space is effective for them. I really loved the CEO of Google the other day saying they were going to invest, billions of dollars in building new offices. And I think that they are one that recognize, and we pay a lot of attention to what they do, that if we make really wonderful, delightful spaces where people want to work, people want to go to the office. It isn't that people don't want to be in the office. It's people don't want to commute, and they don't want to commute to sit on Zoom if they could just stay home and sit on Zoom. But for collaboration and everything else, it can be a better environment if your employer is committed to making it that better environment.
I 100% agree with you. The irony is that we're actually on Zoom. But no, I 100% agree with you. It's like I don't think we're kind of, I think hybrid's here for sure. And I think that the office is not dying despite what we read in the media. Yeah.
No, but it has to be great. It has to be the place where you can work best. And people are paying more attention. I was really encouraged. I was speaking with the CFO of a large engineering firm who said that employees are actually bringing CO2 monitors with them to the office. So we have a strong thesis on indoor air quality. I mentioned 75F before. That was really the first HVAC investment that we made, and because it was quite obvious that if you were collecting data about the indoor environment and then you used machine learning to try and optimize how the equipment functions, you could deliver a better experience. Optimal? No, because at the end of the day, you're limited by the capabilities of the equipment. One of that got us more thinking about what is really the process around delivering indoor air quality. And that came to the next thing, which is this big energy consumption is on the conditioning of the outside air that we want to bring in, which depending on where you live may or may not be any good, right? There's this blanket idea that outside's better, not always true. So that has to be conditioned. And that led us to a company called Enverid. Enverid actually uses a sorbent material that is similar to that which we use on submarines and the space station to clean indoor air, remove CO2, remove pollutants, remove VCOCs, and be able to use a lot less indoor air while delivering the exact same indoor air quality. That was really revolutionary. And we said, okay, when you add that in, that's really great, but you're still moving air through a space. Well, we come to learn that you lose 10 to 40% of that very expensively conditioned air gets lost in the transmission around a building through the leaks in the ductwork. And so that's why we invest in an AeroSeal, which is a way to permanently seal up all those leaks, because if you're going to spend that money, and when you just see how easy it is to create better efficiency, and now if the tenant cares an awful lot about, today CO2 might be being used as a proxy for whether or not they're getting enough fresh air or new air. There's been studies that show the productivity and the cognitive function of people is diminished as CO2 levels go up. We've all been in that overly crowded conference room space with lots of people talking, and it drones on as the CO2 gets higher. Our belief is that we're going to see tenants who put lease terms and SLAs that say conference rooms can never be above 600 parts per million of CO2. Just like they're going to want to have SLAs around light quality and around noise quality. And that kind of pressure, again, back to if the experience is great, people want to be there. If the experience is bad, they're not going to renew. Those cash flow streams are going to be a lot less predictable for landlords. So it's a challenging time to be a landlord.
I'd be remiss if I didn't ask this. Being headquartered in Boston, and there's a huge biotech scene there. Do you ever find yourself in those conversations, in the biotech conversation? And the reason I ask that, there's a handful of owners, institutional owners that are actively monitoring for health and wellness of their buildings, not in terms of health and wellness of like functionality, but health and wellness in terms of like disease.
Yes. Yeah, no, it's a great question, and the answer is yes. So our real belief is, and I had Jim Whalen, the CIO, CTO of Boston Properties, with me on a panel the other day, and Jim is really famous for saying, we have buildings with smart technology, but no smart buildings. And I think he's right when we come to the spaces that we live and work in. But the panel before Jim, we had some folks all from mission critical, pharma manufacturing and data centers. And the truth of the matter is we do have smart buildings. Data centers are hyper efficiently focused on delivering the optimal experience for their tenant. That tenant happens to be a chip that cannot be cooled once it hits a certain thermal threshold. And so you pay an awful lot of attention to the humidity and the temperature in those spaces and the control systems to be able to deliver that. The reality is we pay a lot more attention to is the chip having an optimal experience, are the pharmaceuticals that we're looking to build, to manufacture having an optimal experience. Our belief is that we're going to have these technologies where it's obviously very worthwhile in those sorts of mission critical buildings and hospitals to care about those things because it helps drive or detract from revenue. That those mission critical technologies will find their way into the commercial and residential spaces, just like we see pressure from the other side where all the sorts of things of hospitality are also converging into that space. And so you have to deal with both. And so while it's worth it to instrument, every square foot of a data center, eventually it will be in a residential building, in a commercial real estate building.
Travis, I can honestly talk all day about this stuff. I find this stuff very fascinating, and I really appreciate you coming on the show today. Before I let you go, I definitely want to make sure you have an opportunity to hand off to our audience where they can learn more about you, Building Ventures, and any other resources that you want to share or any other insights that you'd like to share.
Sure. Well, I think that fundamentally, the mission that we're on, and Ash, I really appreciate the opportunity to share more about it with your audience. I think collectively as an industry, we have the opportunity to deliver what we call a better built world, and that's really important to us, and it should be important to everybody. I do know that consciousness around that has certainly been elevated, WeWork aside, in the past couple years to this thing. And so you can find out more about what we're doing, but most importantly about our portfolio companies, because they're really the ones who are making the impact, at our website, buildingventures.com. We do post some thought pieces there about the way that we see the world, the opportunity. If you are an entrepreneur, I would encourage you to tell us about what you're doing on our Connect page. The firm tweets at Building VC, and I do occasionally as well at Travis_Connors. But as I said, we're really interested in moving this industry forward. We want to encourage entrepreneurs, and we're very very desirous to try and help create connections between the community of folks that work with us, whether our LPs or just our friends, and really interesting solutions that can help their businesses. So find us and reach out.
All right, everyone. Well, Travis, thank you so much. That's all we have for you today. If you're loving the show, please go ahead and subscribe to our PropTech Venture Capital newsletter, Weekly PropTech by the Center for Real Estate Tech and Innovation, and follow us on LinkedIn and Twitter. I'd love it if you could reach out and tell us what we're doing well and how we can, and suggest any great insights and panels that you'd like for us to kind of unlock. You can reach out to us on Twitter. You can also find me on Twitter at @azandieh or on LinkedIn. And with that, we'll see you again next time. Thank you again, Travis.
All right. Thanks, Ash. Take care.